Do insurance companies and agents have a specific code of ethics that dictate all their actions and business decisions? We're going to talk about these principles today. What is up? You're watching Tito Talks non-life insurance discussions once again with me, your favorite Tito Miguel, who loves to make non-life insurance discussions easier to understand for both agents and clients. Magandang middle of the week to you guys. Halfway through the work week, so glad that you could drop by for another session here with Tito Talks. And still, we're at it again. We're back to your basic insurance videos as compared to other business specific or line of business specific videos to help those of you who are still new and fresh to the industry. And as mentioned in our intro earlier, we're going to talk about the specific code or a specific rule, a set of rules that insurance companies and agents adhere to within the country. And no, I'm not talking about the insurance code, but yeah, that is a pretty important document. Let's not forget that. Of course, the insurance code is very important, but what I'm talking about today, or what we're going to be discussing over the next few videos, in fact, this is part one of a three-part series, we're going to be talking about the 6 principles of insurance to which insurance companies and agents adhere to. This is a set of 6 guiding principles that point us towards the right direction when it comes to creating new products, when it comes to processing claims, and it also helps guide agents to lead them to the better decisions that would help both them and their clientele as well. Well, Miguel, that sounds pretty boring. Do I have to memorize them for some sort of test? Yeah, you have to. I'm not kidding. Yes, there is a test, not a test from Tito, but a test from the Insurance Commission, i.e., your licensure exam. And whether you like it or not, some of these 6 principles, or all 6 of them, are going to show up on your licensure exam. So, number 1, yeah, it's important. And number 2, understanding the core teachings or the core idea of these 6 principles will actually allow you to answer a lot of questions from your customers regarding their policies and regarding certain rules. Now, in total, we have a set of 6 principles, as mentioned earlier. That would be the principle of insurable interest, the principle of indemnity, the principle of proximate cause, contribution, subrogation, and utmost good faith. So those are your 6 various principles that you have to remember, and we're gonna chop them up into 2 principles each for the next few videos. So we're gonna be covering them within the next 3. So we'll be done right about early next week. So I hope you stay tuned for that. And as promised today, let's talk about insurable interest and utmost good faith. Now, this first principle, the principle of insurable interest, probably one of the first things you'll have to learn as an agent. And it sounds quite interesting, and the implications are quite interesting as well, and it solves a lot of problems for you. Why is that so? Well, the principle of insurable interest simply dictates that you can only insure something in which you have an insurable interest. That's a pretty cyclical definition, and it doesn't give you much to go on. Well, let's dive into the deeper ramifications or the deeper implications of insurable interest. What do we mean when we say insurable interest? This term in itself refers to a very specific kind of relationship that you may have as a person with either an asset, which could be something that belongs to you, or it could be a person connected to you in some way. Now, this relationship is an economic relationship in nature. Now, what do we mean when we say economic relationship? That means if something happens to this asset, to this person, you will be affected economically. In some cases, you are already affected economically by the mere existence or by the mere utility or by the mere fact of having this person or having this asset in your life. If you own it, you're experiencing certain benefits, you're experiencing certain advantages, you're experiencing certain profits from this particular asset. On the other hand, if something does happen to this asset and if something does happen to this person, you will also be affected financially, which means you'll be incurring losses because you would have to pay for repairs, you would have to pay for replacements, you would lose income potentials, you would lose out on profits. And this is what we mean when we say an insurable interest. You have to take care of this asset, this person, because if something does happen to this asset or this person, you are affected positively or negatively by this change or by this event. That is how you establish if someone has insurable interest in something. And from this very definition, it's easy to see that almost everything you own, everything you've bought for, everything you've paid for with your hard-earned money is something in which you have insurable interest. Your car, your house, your phone, your laptop, your what do you call this? Your various gadgets, your belongings inside your house, your furnitures, even your money. These are all things in which you have insurable interest. And that's already established. But it's not just with assets. You also have insurable interests with people, i.e., you can insure your wife, your children, your people whom you're responsible for, and interestingly enough, you can also insure people who owe you money. Yes, that's right. People who have a financial obligation to you are people in which you have an insurable interest. If something happens to them, you're gonna be affected financially whether you like it or not because either hindi sila makakapagbayad ng utang, hindi nila mafulfill yung mga monthly payments ninyo. And this is one of the reasons why banks and other financial lending institutions require you to get insurance when you're taking out loans, especially car loans. Have you ever noticed if you took out a car loan with a bank, they're always going to require you to get insurance? This is because the bank has an insurable interest in the car as well. Because if something happens to that car, chances are they're going to be screwed as well because they lent you the money to buy it in the first place. And that's what insurable interest means. Isn't that interesting? The next principle that we're talking about is the principle of utmost good faith. And this one is a pretty important driving factor when you deal with your clients, especially when you meet your clients for the first time. We always operate on the principle of good faith, which dictates that both the insured and the insurer have to be forthcoming with all material facts before the issuance of the policy can take place. That means we have to be upfront with our clients, and our clients are expected to be upfront with us as well, because a violation of this policy could lead to problems and potentially the voiding and cancellation of their contracts. What do we mean when we say material facts? Well, we'll have a separate video on material facts, and I'm going to link it up right here as well, just in case you want to find out. But for the simple gist of it is that material facts are very, very important details about your client, about the policy, or about the asset that could have serious effects on how the policy will be drafted. Now, a good example of a material fact would be the usage of a particular car. Now, if you check out our video about three things that your insurer needs to know, it's quite closely connected with this topic as well. Now, let's say you use the vehicle for private purposes. You simply use it to go to work, go to the mall, do your groceries. That's one thing. However, if you start using the vehicle as a TNVS and you enrolled it into a service such as Grab, which you're now using to earn money for yourself, that's a different case from a private vehicle. Why is that, Miguel? I'm still using the vehicle for my benefit. Yes, that's true. However, the exposure of the vehicle is quite different. If you're just using the vehicle for private purposes, the exposure is rather easy to predict. Bahay. Opisina, bahay, opisina. It's really predictable to know where the car is being used. However, if used for grab purposes, don't you think that's gonna change the usage of the vehicle? Kung saan-saan napupunta yung sasakyan, kung sino-sino pa ang sumasakay. And therefore, this is a change in usage that the insurer has to know in order for them to appropriately assign the right premiums and the right risk levels for your asset. And this is an example of a material fact. We have to know this, and your customer has to be forthcoming with that information. On the other hand, we, and that includes you as an agent, insurance companies and insurance agents have to be forthcoming with all the various aspects of the policies to which your customer needs to know. That means you have to be transparent about your coverages, the clauses, the conditions, the warranties, the premiums, deductibles, depreciations, and all that sort of things. Things that Tito is going to help you understand over the course of the next few videos. Don't worry. We're going to take care of those topics so that they're easier to explain to your clients. But going back to the original topic, when we operate on the assumption that we're supposed to give out every necessary piece of information to our customers, and the same is expected of our customers. They should be forthcoming with that information to us, because if they don't, and we have a breach in utmost good faith, this could lead to denial of claims, or worse, the cancellation of the policy because of a failure of miscommunication. I'm not telling you guys to start scaring your customers. Hala, totoo ba yan? Ha? Hindi mo ginagamit na Grab? Hindi mo ginagamit na for private use? Sigurado ka? Bala ka? No, no, no. That's not what I'm saying. But it is safe to assume that our customers are giving us the forthright information. And if you do have a solid form of trust with your customers, they will be forthcoming with that information to you, especially when they're changing the usage of the vehicle, or worse yet, if they sell the vehicle to someone else. You're going to be the first to know as an agent, and likewise, you're going to have to inform the insurance partner that you have so that they could update the policy, change the name of the customer, assign new premiums, so on and so forth. So it's a very integral part of what we do as agents. Now, wasn't that a very interesting discussion that we had today? And to prepare you for the next topic that we have, which will be given this coming Friday, I've got a very interesting question for you, which will introduce our next two principles. Now, let's say you have 3 cars that were involved in an accident, and the accident goes as this: Car A crashes into car B. And because car A crashed into car B, this caused car B to crash into another car, which is car C. So you have 3 cars all involved in a series of collisions. Car A crashed into car B crashed into car C. My question for you is, which car is responsible for the damages to car C? So which insurance company of car A or the insurance company of car B is going to be responsible for the damages made to car C? So I want to hear what you have to say. Leave me a like on this video. Leave me your comments, your answers, and your suggestions as well in the comment section. I look forward to hearing from you guys. It's going to be a good discussion next coming Friday. There you go. So thank you so much once again for spending your time with your favorite Tito. And once again, this is Miguel, and I hope you enjoy the rest of your day.